Okay, it's time to confess. We all have dreamt of turning $100 into $1 million overnight. But the reality of investing is often a bumpy ride, riddled with potholes called costly mistakes. A recent study by Dalbar found that the average investor underperforms the market by 50% annually. And 80% of investors admit to making at least one major investing mistake in their lifetime. What are those mistakes and how do we not make them in the first place? In this video, we're about to discuss the 5 terrible investing mistakes that can ruin your financial success and reveal actionable strategies to avoid them. So without any delays, let's get started with it. Number 5. Putting all your eggs in one basket. As a metaphor, putting all your eggs in one basket is cute, but when it comes to investing, it's a bad idea. The numbers make it clear that investors who don't spread their money across different asset classes, industries, and even individual holdings are making one of the worst mistakes possible. Let's understand this by an example. Placing your life savings on a single stock, like Enron, in its pre-scandal glory. When the inevitable collapse hit, investors lost 90% of their value. Now spread that same investment across 20 different stocks in various sectors. While Enron might still tank, the impact on your overall portfolio would be blunted, potentially minimizing losses to just 5%. That's the power of diversification. Dalbar's 2020 study found that over the last 30 years, the average stock owner has lost 2.34% a year compared to the S&P 500. Why? A lack of diversity in investment based on emotions were the main reasons. Investors often rush to buy hot stocks or sell quickly when the market drops, worsening losses. A diverse portfolio, on the other hand, encourages a more calm and data-driven approach, which can smooth out market changes and increase returns. What really makes this work are these things called uncorrelated assets. When asset classes move in opposite directions, they can offset each other's losses. For example, stocks may drop during a recession, but bonds tend to rise as buyers look for safe options to put their money. Spreading your money around these different types of assets can lower your risk and keep you stable. Diversification is more than just throwing darts at an asset class dartboard, though. Too much diversification can dilute returns, while too little leaves you exposed. Finding the sweet spot depends on your risk tolerance, investment goals, and time horizon. A young investor with a high risk tolerance might lean towards a growth-heavy portfolio with more stocks, while someone nearing retirement might prioritize stability with a higher bond allocation. Don't forget that diversification doesn't protect you from losing money, but it can help you handle the expected ups and downs of the market. So the next time you want to put all your money into one investment, think about Enron and how smart it is to spread your bets. Number 4. Not having clear financial goals. Investing without clear financial goals is like driving in the dark. You might end up somewhere, but it's probably not where you intended. Lack of foresight can lead to haphazard investment decisions, potentially exposing you to unnecessary risks or missing crucial opportunities. Consider Peter, a 25-year-old investment newbie. Hearing about the potential for high stock returns, he throws his savings into a few popular tech stocks. Initially, everything's great as the market climbs. Peter feels like a financial genius. However, the tables turn as the market dips, and Peter's portfolio shrinks significantly. Panicking, unsure what to do, he sells everything at a low point, locking in his losses. What went wrong for Peter? No goals. He lacked clear financial objectives like buying a house, retiring, or traveling the world. He didn't consider his risk tolerance or investment time frame. Swept away by temporary market emotions, he ended up paying dearly. Research backs this up. A Morningstar study revealed that investors with defined investment goals earn an average of 4 to 5% more annually than those without. Why? Goals provide direction and discipline. They help you choose investments aligned with your ambition and make rational decisions during market fluctuations. When COVID-19 hit and the market took a dive, our natural inclination was to think, should I just cut my losses now and sell? Says Ford. But in 2020, that kind of short-term thinking would have disadvantaged an investor as the market took a surprising upturn. Don't focus on immediate returns, advises Ford, but rather on where you might want to be a few years from now, or even later in life. Investors without goals are more susceptible to short-term temptations like risky, high-reward ventures. While these may offer big wins, they also pose the potential for devastating losses. Goals help you stay focused on the long-term plan, avoiding emotionally driven decisions. Number 3. Timing the market. Trying to time the market could be the worst thing you can do when investing. Even though buying low and selling high is very appealing, it's hard for even seasoned professionals to do it all the time. Think about the famous words of Warren Buffett: "Be fearful when others are greedy, and greedy when others are fearful." Easier said than done, right? Here's why timing the market is fool's gold more than investment strategy. History isn't kind to market timers. Studies show that missing the best 10 days in the S&P 500 over the past 30 years could have slashed your returns in half. And it's not just a one-off. Missing the best 30 days could have reduced your returns by a staggering 83%. So trying to time the market might cost you more money than just staying invested. And let's be honest, emotions and investing don't always mix well. Fearful investors often sell during downturns, locking in losses, while overly optimistic ones might chase risky bets at market peaks, setting themselves up for disappointment. Sticking to a diversified portfolio based on your long-term goals helps you stay calm and avoid these emotional pitfalls. Moreover, predicting the market's exact movements is like trying to control the weather. Economic data, geopolitical events, and unforeseen circumstances can all throw a wrench in even the most carefully crafted predictions. So what's the alternative? Focus on what you can control. Spread your investments across different asset classes and sectors to minimize risk and smooth out market fluctuations. Most importantly, time in the market, not timing the market. Staying invested for the long term through ups and downs has historically been a winning strategy. Remember, even investing legends like Warren Buffett advocate for a buy and hold approach. While market timing might seem glamorous, it's often a recipe for missed opportunities and unnecessary stress. Number 2, being an emotional fool. Letting emotions take the wheel when it comes to investing can be a real game changer, not in a good way. You've probably heard that old saying about fear and greed ruling the market, and there's some truth to it. But instead of letting those emotions drive your decisions, keeping your eyes on the bigger picture is essential. Sure, the stock market can be a roller coaster, with ups and downs that can make your head spin. But history tells us that patient investors usually come out on top in the long run. See, when faced with a rough patch, some people might panic and hit that sell button, but sticking it out could be the smarter move. In fact, being patient might even let you capitalize on the knee-jerk reactions of others. So next time your emotions start to cloud your judgment, take a step back, breathe, and remember patience pays off in the end. Number 1, not understanding the investment. One of the worst mistakes new investors can make is diving into investments without fully understanding what they're getting into. In fact, studies show that a lack of understanding is a significant driver of poor investment decisions. According to a FINRA Investor Education Foundation survey, nearly 2/3 of Americans cannot pass a basic financial literacy test. This lack of knowledge leaves them vulnerable to making costly mistakes. Take the case of the dot-com bubble in the late 1990s. Many investors poured their money into tech stocks without understanding the underlying fundamentals of the companies they were investing in. When the bubble burst in 2000, investors suffered massive losses. Similarly, during the housing bubble of the mid-2000s, many individuals jumped into the real estate market without fully grasping the risks involved. When the housing market crashed badly in 2008, these investors were left holding the bag. To avoid falling into this trap, educating yourself about different investment options, understanding the associated risks, and having a clear investment strategy is crucial. By learning about investment and seeking advice from financial professionals, you can make the best decisions and avoid the most costly mistakes in the long run. Are you also making the same mistakes? Or some others we didn't list? Let us know in the comments section below, and don't forget to subscribe to the channel. See you in the next video.